Welcome to Yahoo Finance Sports Report, a unique look at the business of sports, brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'm here to coach you through the financial game. We'll look beyond the headlines, analyze all the latest sports news, the teams, trades, and billion-dollar deals, so you and your portfolio will win big. This week, we're getting into NFL ratings, breaking down the latest in MLB's postseason revenue-sharing numbers, explaining why it's a big deal that GM is joining Formula One, and so much more. Plus, we've got Bobby Sharma, managing partner of Bluestone Equity Group, stopping by the show to discuss investing in professional sports. Let's huddle up and get right into it. All right, it's time for this week's Pomps Playbook, where I take a look at some of the biggest headlines in sports that you and your portfolio need to know. Let's kick things off with the NFL on Thanksgiving Day. Now, the NFL on Thanksgiving Day is a tradition as old as time. The NFL has actually been hosting Thanksgiving Day games since the league was founded in 1920. And now they broadcast 3 individual games each Thanksgiving Day. These 2 teams are grandfathered in with the Lions and the Cowboys. The Lions play in the morning, the Cowboys play in the afternoon, and now the NFL has added a 3rd game in the evening. But the reason why I want to talk about this today is because the Cowboys and Giants put up a particularly large number. If you think about the Cowboys and Giants, these are obviously 2 big market teams that would typically draw a large number, especially on Thanksgiving Day. But this year's game was a little bit unique because it was 2 of the worst starting quarterbacks in the league today. Both backup quarterbacks for the Giants and Cowboys with Drew Lock and Cooper Rush played, and the game wasn't very exciting. Still, it averaged 38.5 million viewers, which will likely make it the most watched regular season game this NFL season, and the 4th most watched Thanksgiving Day game ever. And not to be outdone, even the Miami Dolphins and Green Bay Packers put up a huge number at 26.6 million in the late night game. Now, we don't have the final number from the Lions game earlier in the day since CBS ended its contract with Nielsen this past October, but I'm sure that'll be just as big given the Lions have become a mainstay on Thanksgiving Day for the NFL. The next thing I want to talk about is Andrew Luck being named GM of the Stanford football team. Many of you remember Andrew Luck from his playing days with the Indianapolis Colts, even though he retired at 29 years old in the thick of his career because of injuries. But Andrew Luck is back now, returning to his alma mater as the general manager of the football team. This is sort of a unique role because it wasn't a real role in college football until a few years ago, but now major programs like a Stanford or an Alabama or a Georgia are now hiring general managers. In this role, Andrew Luck will be responsible for everything Stanford football. That includes managing the coaching staff, the player personnel staff, player recruitment, the athlete roster, and player experiences. But it'll also oversee the entire business side of things, which has changed a lot over the last few years. We're talking about fundraising, sponsorships, attendance at games, sales, the in-stadium experience, and alumni relations, including, as I mentioned, fundraising. This is a super unique role for Andrew Luck, and things can only really go up from here. I mean, Stanford has endured 5 losing seasons in the past 6 years, so now Andrew Luck will look to partner with the school's coaching staff to improve their football program through fundraising and other means like that. One other thing to keep in mind on is that he's going to have to navigate the House settlement that's come out earlier this year, where these schools are going to be allowed to share between $20 to $30 million with their student athletes starting potentially next year. And the last thing I want to talk about today in Pomp's Playbook is MLB's playoff revenue sharing pool. Now, there is a complex formula that goes into this, but the easiest way to think about it is that MLB players stop receiving game checks at the end of the regular season, given that not every MLB team makes the playoffs. So to continue to pay players throughout the postseason, what MLB does is they gather the ticket revenue from all the teams and all the games. This all goes into one pot, and then it's split on a percentage basis between the players, the ownership offices, and a bunch of other organizations as well. And with that, the players receive generally about 60% of this pool at the end of the postseason, depending on how many games and how much ticket revenue is calculated. This year, that came out to $129 million. That's a 20% jump from the $107 million record that came out last year. But the most interesting part about this is after the postseason is over, each of the team's captains go into a room and they literally vote on how they want to decide to give up their money in their pool. So take the World Series champion LA Dodgers, for example. They took home $46 million, the highest earning team last year, because they ended up winning the championship. They then give out full shares and partial shares to players, but also clubhouse personnel, trainers, and other staff on the team. This week for the deeper dive, where I give you a play-by-play analysis of news in the sports world and its significance to your bottom line. We're talking about GM joining Formula One. Now, for those of you who follow Formula One or anyone who is interested in sports business, you've probably seen over the last year that Michael Andretti has been trying to add an 11th team to Formula One. So many of you were probably surprised when Formula One released a press release last week, officially announcing that they had added an 11th team, but didn't mention Michael Andretti's name. This team is GM and its Cadillac brand. Now, the significance of this is that Michael Andretti essentially burned a lot of bridges around the sport, and a lot of people didn't think he added enough value. So Formula One told him, we'll let your team in, but you have to go find a bigger partner. This is where GM came in, which made a lot of sense because its Cadillac brand was already included in the initial bid. So Michael Andretti, his parent company that owns his racing business, TWG Global, and Cadillac and GM partnered on this bid. Now, the reason why this is so significant is because Formula One has grown a lot over the last several years. When Liberty Media bought the business in 2017, they were trading at an enterprise value of around $8 billion. This sport is now worth nearly $20 billion in total. It's grown nearly 2x or more over the last number of years. And now they're adding an 11th team. So to get into the league, into the sport in general, GM is going to have to pay a $450 million anti-dilution fee. Now, the reason they have to do this is because all of the other 10 teams in Formula One are essentially allowing them to participate in their revenue sharing agreement, the same thing that you would find in the NBA or NFL. So you have to pay this huge upfront fee, plus hundreds of millions of dollars more in car development, building out a staff, paying the drivers and everything else like this. All told, it's probably going to be $1 billion investment for GM when it's all said and done. Now, you may ask, why is Formula One doing this? Well, they want to grow the American audience. It's become obvious that the biggest way to grow the sport over the next decade is to expand the American audience. This is why they now have 3 races in America after not having a single one more than a decade ago. Those races are in Miami, Austin, and Las Vegas, and they think that American car brand can help grow the sport here as well. And on the flip side, it makes just as much sense for General Motors and Cadillac. The reason for this is because the American car brand sells about 400,000 cars annually, but most of those sales come through America and Canada. And now they want to expand those sales into more F1-minded countries throughout Europe and Asia. And Formula One provides an incredible marketing platform for them to be able to do this. I mean, if you just think about the total size of the audience, 1.5 billion people tuned into Formula One races last year. Each race averages about 75 million viewers. That's nearly Super Bowl viewership, but instead of 1 game per year, it's 25 races each year throughout the world. So if GM and Cadillac can sell more cars internationally, this $1 billion fee might look like a bargain in the end. And that's without even mentioning the fact that almost all of the Formula One teams are now profitable, and some of them, like a Ferrari or a Mercedes, are worth $4 to $5 billion. We've made it to the one-on-one, a conversation where I get to break down news and sports with a key player in the industry. This week, I am joined by Bluestone Equity Partners managing partner and former NBA executive, Bobby Sharma. I first want to start with some background on you because I think your journey in sports is incredibly unique. You started as a lawyer, you were working at the NBA, eventually helped them build out their minor league system, which is now known as the G League. You've been at IMG and now you're investing. Maybe let's start with the NBA and just talk to me a little bit about how that came about and how the project with the G League specifically came to life.
Yeah, I'm always happy to talk about that. My days at the NBA were some of my favorite in my career, but I started there in 2002. The NBA launched what was then called the NBA Development League in 2001 because the Continental Basketball Association, that had been around for literally generations to serve the NBA's interest to call up players midseason, went out of business. And quite simply, David Stern and the NBA had to create quickly a minor league to serve that function. I made great relationships at all the major league offices that I still have to this day, including Commissioner Manfred at Major League Baseball, for instance. But I made some great contacts at the NBA, including with this new league, which I sensed spelled opportunity. And sure enough, at 29, I got hired to be the general counsel of one of the NBA's 3 leagues, where I got to learn an incredible, literally like everything there is to about running a professional sports league and professional sports teams, because when this entity was set up, the NBA owned all the teams and the league, while building operating expertise in every facet of sports. So everything from basketball operations to sales and marketing to licensing to PR comms, security, and business. It's basically an MBA at the NBA, which is, I think, was then and still widely considered to be the best run professional sports league in America. And I got to work very closely with David Stern, who I was very involved with the development league in the early days because of the urgency to get it to market. And then Adam Silver, when he became deputy commissioner, who also shares ties with me to both The law firm that I worked at immediately prior, and Duke University, where he's now chairman of the board of trustees and an alumni.
All right, we've got to take a quick break, but we'll be back with Bobby Sharma right after this. Welcome back to Yahoo Finance Sports Report. I'm your host, Joe Pompliano. I'm here with Bobby Sharma, managing partner of Bluestone Equity Partners and former NBA executive. So you spend a good amount of time at the NBA, you go to IMG, you're investing a little bit also, and then you leave a couple of years ago now to start Bluestone. You guys, again, mentioned you've raised over $300 million and you've deployed a large chunk of that so far. What was the thesis behind sports investing specifically, right? I think most people understand raising a large fund like that can be lucrative if you perform well, but why did you guys pick sports specifically?
Yeah, so I was at the NBA from 2002 till the end of 11, and then 10, and then IMG from 2011 to 14. So 4 years there, including being personally recruited by Ted Forsman, one of the pioneers of private equity. I had the incredible fortune of basically taking everything I did at the NBA and apply that internationally. Ted's vision was to recreate the success of the Indian Premier League, which enterprise then was 4 or 5 billion, probably it's recently been measured over 16 billion, but IMG had no equity stake in it. And as one of the founders of private equity, you can imagine how he took that and wanted to find a win there. So his vision was to recreate that success for soccer and basketball league. So that's what he hired me to do. So I got to apply this operating expertise, this domestic network of sports investors, operators, and grow it internationally. Focus on emerging markets like India, China, Brazil, Turkey, Southeast Asia generally, Sub-Saharan Africa generally. And this was when emerging markets were white hot, right? Like early 2010s. And actually, I left IMG beginning of 2015, so quite a bit of time ago. So in that space and time, I took those relationships, I took that operating expertise into the investment world through an M&A advisory firm, and actually didn't seek capital. I had the ability and interest from all the deal making, deal work I did at the NBA, including privatizing the model. It was all single owned by the league, right? We brought in private investors and local private investors and NBA team ownership. And so I got to take all of that operating expertise, deal making expertise, and value creation, which is really what I went to IMG to do with the skills and experience and relationships I had at the NBA, and apply that internationally while I was in an M&A advisory context. So that's what I did from 2015 to 21. And one of my clients was a private equity firm at which I became a partner that was investing in European football assets. I became the CEO of one of them through COVID for 2.5 years. And I had some large pension funds, US pension funds, that were looking to directly invest sports properties. And this was about 2021, and the economics of sport assets at this point, teams, media rights, and the like, had grown to the point where they were relevant as direct investments for institutional investors. So that's in effect what I was doing for those 6 years. But while advising some very large institutional capital in the U.S., they asked me to present to their investment committees for $300 million, which I closed January 31st last year, so 22 months ago.
What industries get you really excited, right? Like if you look at the deals that you've done, they're a little bit different than the traditional stuff that many people in sports are talking about today when it comes to the teams and the leagues and things like that, some of the social networks and things. I know you've been interested in AI and networks as well, but what are some of the industries and kind of businesses that get you excited?
Well, we look at everything. I said that. So yeah. To put a finer point on that, so we look at the sports media and entertainment industry basically in 4 quadrants. So leagues and teams, so essentially IP rights holders, services, technology, and media and entertainment. And to some extent, all 7 of our investments have crossed over into most cases 2 of those sectors. So what gets us excited is a great business with a moat that we can grow. And that's really where we are. Like, we are finding the best opportunities for our LPs. We are incredibly proud, I should say, and grateful stewards of capital. So we just are looking for the best risk-adjusted returns out there, and we're finding them and we're executing on them. great deals, great structure, really, really truly value added capital, which set often in private equity, but I think that we're very hands on with our deals. We have not done a controlled deal yet, but that's something we're certainly capable of. I have a team full of buy side shop experts. So from Apollo, from Abry Partners, Blackstone, Tailwind, just really capable individuals, both in terms of understanding this industry and being financial experts. So I wouldn't say there's any one area in particular. I'd say we've had a nice cross representation of that ecosystem quadrants that I spoke of. So our last deal was a company called Volo Sports, which is a sort of hidden in plain sight, incredible sports platform. So it's adult recreational sports. It's the largest player in that space, and they have an opportunity to own it. So those are the kinds of value creation opportunities that we look for. But yeah, I think historically, the notion of private equity investing in sport seminally was really venture. I think there's a lot of people putting money into technology and services businesses around sports through technology, maybe caught up more into the venture economy that was a lot more vibrant about 10, 15 years ago or so. And I think in recent years, in the last 5, 8 years, certainly 5 years, team investing has been very much on trend. But we don't invest on trends. We look for great businesses. That's not to say that teams can't be great businesses. It's that they often have other challenges as an LP. Liquidity is a giant one that I think was not necessarily focused on by people that have invested in that initially. And also just IRR, right, which is attached to that factor. And but these are the highest performing leagues are a good safe bet for long-term exposure into the industry, but not necessarily the best returns in a given space of time in the industry. That's what we're looking to find.
Yeah, and I'd love to double click on the media bucket that you mentioned earlier just for a second, because you obviously have a lot of experience both in the legacy world, but also sort of the new world and some of the deals that you're looking at. If someone was to ask you where the media rights ecosystem is headed for professional sports, right, with cable obviously declining and streaming becoming more prominent, how would you explain that to someone and kind of where you think it's going to be within the next, I don't know, 5 or 10 years?
Yeah, if you really break it down to its core, it's quite simple. So the professional sports team, asset growth has really been driven by the growth in live media rights. And that has fundamentally grown on the platform of the legacy cable and satellite distribution model. And as that has crumbled as a result of time, technology, cultural shifts, you now have a world where those industries are literally dissolving before our eyes. And so that great economic engine that's driven the growth of professional sports leagues, particularly North America and the highest levels of European football, are going to have to be replaced. And it's a little bit frightening for the major IP rights holders, the NFLs, the NBAs, maybe a little bit less so for the NFL, but the rest of the leagues in the US and Europe, because going direct to consumer is going to necessarily involve a drop in revenue. You're not going to immediately command overnight by going direct to consumer the same economics that you had. And that is almost unfathomable to the major professional sports leagues because they have economics to support. They have players with salary expectations and unions to deal with any repercussions of those economics faltering, much less owners with expectations of valuations. So I think really in the simplest terms, you have a dramatic shift that will be taking place in the next few years of a direct-to-consumer leap, we'll call it, that the major rights holders will have to do. And they have the capital and the technology to be able to do that. The very biggest ones will have the opportunity of the biggest streaming players in the world, which is really where that legacy media industry has been consolidating into the Amazon and Netflix, of course, but also the new ones like Hulu and Peacock and the like. So it's a very interesting time as an investor, given that dynamic, right? That's the primary value driver for those assets. It is part of our analysis and our underwrite when we look at assets like that. And so I think another category, third category, I suppose, of what most people think about when they think about sports investing are new sports properties, new leagues, teams, challenger properties, in some cases, properties that have been around but are sort of rebooting. They all will have an easier time of getting on air, right? "Quote unquote" on air, as opposed to like the gatekeepers of the legacy media companies. But it's going to be an increasingly noisy, saturated media environment. So it'll be a challenge for any one of them to get a foothold and to create real value. And especially in terms of the economics that some of them are selling themselves to projecting.
I love that. Well, Bobby, thank you so much for joining the show. You and Bluestone are doing an incredible job and quickly have become a major player in sports. So I appreciate your time.
I really appreciate your time. Thank you for having me, Joe.
The clock is winding down here, but we have just enough time for some final buzz. So I want to talk about this weekend's MLS Cup final. The MLS Championship game takes place this Saturday, December 7th. The matchup features two huge markets, and it's a huge win for MLS because it's the LA Galaxy versus the New York Red Bull. This matchup will also be the first time in a decade that two of MLS's founding clubs will play each other for a championship. The game will be played at the 27,000-seat Dignity Health Sports Park in Carson, California, home of the LA Galaxy. And the stakes are high for the New York Red Bulls, which are one of only 3 original MLS clubs yet to win a league championship. In fact, the Red Bulls are sort of a Cinderella story. They were the number 7 seed in the MLS Cup playoffs on the Eastern Conference side with an 11-14-9 record this past season. And they're the first number 7 seed to play for the MLS Cup. But the reason I'm most excited about this is because the viewership numbers should be pretty good. Look, Lionel Messi isn't in it, and obviously that's a loss for MLS. But while most games are on MLS Season Pass subscription through Apple TV, the MLS Cup Final will be broadcasted for free in the U.S. on Apple TV, Fox, and Fox Deportes. As a reminder, Apple signed a 10-year, $2.5 billion contract with MLS to be the exclusive home of all MLS games, which began last year during the 2023 season. Lionel Messi has obviously helped those subscription numbers, but we don't have much insight into how many viewers each game is actually getting. Although, if this game does go well, I'm sure that Apple and MLS will brag about it because MLS had quite a good year. They had 11.5 million fans attend regular season matches. That was a 5% jump from 2023 with an average of 23,324 fans attending games across the league, an MLS record this past season. And not to mention, club sponsorships were significantly higher as well, a 13% jump year over year, with the league adding 18 new partners this past season. So all eyes will be on the MLS Cup final this weekend between the Galaxy and the Red Bull. And I'm sure MLS is hoping for another huge viewership number, given that it's free on broadcast television as well. We're all out of time, so it's officially game over for this week. Thank you so much to Bobby Sharma and for all of you for joining us. Make sure to tune in to Yahoo Finance Sports Reports on Thursday at 5 p.m. wherever you get your podcast. I'm your host, Joe Pompliano. See you next time.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.